AppLovin stock has taken a sharp turn in 2026, and if you've been watching this name, you've probably noticed the volatility. The stock is now down roughly 47% from its 52-week high, and just today, it dropped another 4.69% during regular trading hours. So the big question is, what's going on with App stock, and is this a buying opportunity or a warning sign? Let's break it all down. First, let's talk about what happened today and the recent performance. As of April 8th, 2026, AppLovin closed at around $391. This comes after a pretty brutal stretch for the stock. Year-to-date, App is down roughly 43%, which is a massive reversal considering how strong it was before. Remember, this stock surged about 700% in 2024 and then gained another 100% in 2025. That kind of explosive growth often sets up a pullback, and that's exactly what we're seeing now. Today's drop of 4.69% seems to be tied not just to company-specific issues, but also broader market concerns. In particular, investors reacted to Anthropic's announcement of managed agents, which sparked fears that newer AI models could disrupt existing SaaS and AI monetization models. Since AppLovin is heavily tied to AI-driven advertising, any perceived threat to that ecosystem can hit the stock quickly. Now, if you're new to this company, let's quickly go over what AppLovin actually does. AppLovin is essentially an AI-powered advertising platform focused on mobile apps. Its core engine, called Axon Intelligence, processes billions of ad requests daily and uses machine learning to optimize which ads get shown and to whom. This is all about maximizing revenue for app developers. Then you have Max, which is their mediation platform. This allows multiple ad networks like Meta and Google to compete in real-time auctions for ad placements inside apps. That competition drives higher revenue for developers and, of course, for AppLovin. On top of that, there's App Discovery, which helps developers acquire high-value users, and additional products like Adjust and Whirl, which expand into analytics and connected TV advertising. So overall, this is a company deeply embedded in the digital advertising and AI ecosystem. Next, let's look at what analysts are saying. Right now, the one-year average price target for App is about $704.71. That implies nearly 80% upside from current levels, which is pretty significant. Most analyst estimates fall in the range of $700 to $860, suggesting strong confidence in the long-term growth story despite the recent pullback. Looking even further out, some algorithm-based projections are extremely bullish. There are estimates suggesting the stock could reach around $1,600 to $1,700 by 2026 and potentially exceed $3,800 by 2030 if the company continues to execute on its AI-driven expansion. Of course, those long-term projections come with a lot of uncertainty, but they do highlight the scale of the opportunity investors see. Now let's talk valuation because this is where things get interesting. After the recent sell-off, AppLovin's valuation has come down quite a bit. The trailing P/E ratio is currently around 39 times earnings. That might sound high at first glance, but when you consider the company's growth rate, it starts to look more reasonable. In fact, the forward P/E ratio is around 0.94, which many analysts consider attractive. A P/E ratio below 1 often suggests that a stock may be undervalued relative to its growth. Compared to peers like Adobe, AppLovin actually looks compelling on a growth-adjusted basis. Another key point here is profitability. The company has been generating very strong free cash flow, with margins exceeding 70% over the past year. That's extremely high and indicates a very efficient, high-margin business model. So, naturally, this brings us to the big question. Is this a good buying opportunity? There are two ways to look at it. On one hand, the stock has dropped nearly 50% from its highs. Valuations have compressed, and the business fundamentals, especially around AI and advertising, are still strong. Importantly, the forward P/E ratio is now around 24.7, which is significantly lower than before and suggests the stock is becoming more reasonably priced relative to its expected earnings growth. From this perspective, this could be a good entry point to start building a position. On the other hand, the market clearly has reasons to be cautious. When a stock falls this much, it's usually not random. So let's talk about the risks. One major concern is regulatory and legal uncertainty. There have been reports about potential SEC scrutiny related to data collection practices, and even though nothing has been confirmed, this kind of headline risk can weigh heavily on investor sentiment. Another issue is that AppLovin has been a frequent target of short seller reports. These reports have raised concerns ranging from data practices to compliance issues. The company has strongly denied these claims, but the presence of repeated short attacks adds volatility and uncertainty. Competition is also a big factor. AppLovin operates in a space dominated by giants like Meta and Google, and now you also have emerging AI-native competitors entering the market. If these companies develop better ad targeting or monetization tools, it could pressure AppLovin's margins over time. And finally, there's platform dependency. AppLovin relies heavily on Apple and Google's mobile ecosystems. Any changes in privacy policies, app tracking rules, or platform fees could directly impact its business. Before we wrap up, here are a few additional things investors should know. The company has recently been going through leadership transitions, including appointing a new independent chairperson and planning rotations for key executive roles like CTO and Chief Legal Officer. Leadership changes can be positive, but they also introduce uncertainty in the short term. Also, AppLovin has been shifting its focus away from game development. It has largely divested its Lion Studios business to concentrate on its higher-margin advertising software platform. This move signals a clear strategy: double down on AI-driven ad tech rather than content creation. So to sum it all up, AppLovin is a high-growth, high-margin AI advertising company that has seen an enormous run-up followed by a sharp correction. The fundamentals still look strong. Analysts remain bullish, and valuation has become more reasonable. But the risks are real, especially around competition, regulation, and market sentiment. Whether this is a buying opportunity really depends on your risk tolerance and time horizon. Thanks for watching, and if you found this breakdown helpful, make sure to like the video and subscribe to the channel for more stock analysis just like this. And as always, this analysis is for informational purposes only and is not investment advice.